Good afternoon and welcome to Technical Analysis Explained. I'm your host, Tom Schneider, CMT with NinjaTrader. And before we get into the good stuff, I do want to remind everybody that futures and options trading contains substantial risk. Is not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose. It doesn't keep you up at night, and it doesn't extend your retirement horizon. Very important on this show to understand that past performance does not indicate future results. And of course, what we talk about on this live stream does not contain trade recommendations nor financial advice and should be taken for educational purposes only. So with the disclaimer behind us, I do want to explain what this show really is about. And this show is trying to understand concepts of technical analysis that you might hear that we talk about on our regular shows, on our opening range and bars closing, or even like see the futures on Wednesdays. Sometimes the guests do talk about technical analysis. We do certainly talk about technical analysis on Traders Workshop. And then, of course, I have a show with Anthony Crudelli on Thursdays called Develop. Sure, we talk about technical analysis. So this show is meant to dig a little bit deeper in some of those that we might talk about on the other shows. So this week's topic, let's talk about the MACD. What MACD stands for is Moving Average Convergence Divergence. And it was formed or developed or discovered, you might say, by a gentleman by the name of back in the 70s. He did some research, and I think it was very smart research. It takes this idea that we talked about last show about moving averages, and it takes it, I think, to the natural extension, to the next level, which is to say, moving averages try to help us smooth the data and identify trends. And in the smoothing of that data and identifying trends, the idea is we can not even identify the trends, but we can also try to see when trends change, when the trend may be changed. Gerald Appel took that idea with the MACD, and he just kept going with it. And maybe if I show you the chart, you can see what I mean by that. So let's a daily chart, and I've got a moving average in blue, this dashed blue. I'm going to use the defaults that Gerald Appel uses to show how he came up with the MACD. But you might have a different look if you have your own E-mini S&P chart up. But we'll use the defaults that Gerald Appel uses. This, in fact, is not a simple moving average. This is an exponential moving average. The exponential moving average is slightly different from a simple moving average in that it puts more emphasis on the most recent data that comes into the chart. So this bar right up here has more weight than the bar at the end of the data series. Now, what is this moving average? This is, let's double click, and it tells me right here, this is a 26 period exponential moving average. Now, it's not so important to understand why he used 26. I believe it's just a matter of going through the data and find out what provided him the time. You can certainly change that up. If you like a 30 period moving average or a 50 period moving average with the MACD, by all means, we give you the ability on the NinjaTrader platform to do that, to change that. But the default I see so many times with the MACD is pretty standard. So we're going to use those. Telling me this 26 period moving average smooths out the data. So I can see the uptrends. I can see the volatile as the data itself, the candlestick bars underneath. The moving average can be used, like I said, as support resistance. It can be used to identify trend, but also it can be identified as a threshold that when price closes below this or closes above, it might indicate or the tops of the trend change, but that's okay. It's more of a confirmation that, yes, this looks like a trend that is in place. So taking that idea of using price to cross this moving average up or down as a way to identify trend change, can we do that with other moving averages? And of course, the answer would be yes. I wouldn't bring that up if it weren't. But let's look at this now. And I've got slightly different view. It's the same data. It's a daily E-mini S&P chart. And this time I've put a slightly faster moving average on that. And what I mean by that is a faster moving average means a less use to calculate that average. So whereas this moving average that we saw before on that other chart is a 26 period, this is a 12 period, again, using the defaults in the MACD. And what Gerald Appel was trying to do was trying to see if we can use the crossover of these moving averages in a smart way. And that's what the idea of moving averages do, is they smooth out the data so that we can look for trend change. And the real smart thing that Gerald Appel did with the MACD is he said, if I can 2 lines to identify inflection points in the market, can we into one data set? And the answer is yes. If we think about this, when these 2 lines cross, they equal the same amount. They're the same value. That is the point. They cross at the same value. So if I take the difference of one line versus the other, that value equals 0, that is an inflection point. So let's look and see what that means. Same studies. I've got the 26 period exponential moving average in blue, and I've got the 12 period exponential moving average in green. And I'm going to just change this study in just a moment, but this is the MACD study, the moving average convergence divergence. And so when I look at this, I see 3 lines. There's a lot here. We'll reduce it just to the MACD line. So if I come over here to indicators, quickly go down to my plots, and for the average, I'm going to change that to transparent. Transparent's all the way at the top of the color list. So I'm going to make that transparent. And for the difference, we'll make that transparent as well, so that we can just focus on the MACD line. Okay, so we've got 2 moving averages up here, a 12 and a 26 exponential moving average. And we've got the MACD line up here. And you'll notice that when these points cross, when these 2 lines cross, I should say, and I'll try to highlight. Oh, my ellipse is red, so you can't miss it. We'll just grab it and move it here, copy it and paste it. Let's see if I can paste it. There we go. Paste. And you could see where they cross, where these lines cross. Let's see, do we have another cross? Yes, we have one over here, and we have one right over here. That's good enough. So if we bring up our crosshair, hit that cross, what's happening here in the MACD? It's crossing 0. So what I like about his thinking and the study here is it takes 2 lines and boils it down into 1. And it boils it down into 1, and it makes it easier to understand. So this line that we're seeing is the difference of these 2 moving averages. That's all it is. It's very simple. It's almost so basic, but Gerald Appel was the one to figure this out. And what's happening here? Well, there's a 0 line. This is where it's above 0 and below 0. We can see that very easily. I'm going to turn off the crosshairs real quick. And so the idea is when the shorter term moving average is increasing and it's above the longer term moving average, it's increasing faster. That means that the price is increasing faster. It's in a trend. It's in an uptrend. And at some point, those trends are both moving up because the price is moving up. But look what happens when the price stalls. This moving average turns down a little bit quicker and a little bit faster than the longer term moving average, the 26. And so we get a cross down. So looking at the MACD, when it's above 0, that'll be bullish. Market's bullish. And when it turns back below 0, market's bearish. Again, you're not going to get market or the bottom of the market, but that's not the point. The point is to understand when this trend is, I wouldn't say safely, because we'll see in times where it isn't safely exactly. It's going sideways, even though it might be going up slightly. Your MACD might be going sideways, but right now it looks like this uptrend is legitimate. We're not at the bottom way, right? And then we turn down. Yeah, we didn't get the top, but now we're in a downtrend. So we boiled two lines down into one. Well, what does that do for your efficiency? It makes you more efficient, right? I don't have to do the calculation and remember, okay, which one is the green line? Is that the 12 or the 26? I think, I know it's the 12 because it's closer to price, but there are some times where it's hard to tell which one is which. Look over here when it's sideways. If I just isolated on this month right here in May, can I tell really which one's the 12 and 26? Not really. But if I don't really need to know, because I know that the MACD is going to be bullish when it's above, bearish when it's below zero, I don't need to know which line is 12 and which line is 26. I just look at the MACD. And according to this chart, the MACD seems to have been bullish since end of April on the E-mini. Well, what's happened since the end of April on the E-mini? Really, since the early March, it didn't catch this so much, but look at that. It's been bullish ever since. And what has the market done? The market has gone up. So again, past performance, not always indicative of future results, but this is the state of a bullishness that the MACD has identified. Basic. So Gerald Appel might have been able to sit down and say, wow, this is great. I've just taken two lines and I am set, right? This is my legacy. But no, he didn't. He went even further. And this is what I love about this. He took this concept of smoothing data and using them for a signal line from the moving averages on the price, and he applied it to his MACD. What do I mean by that? Well, let's go back to the indicator. I'm going to show you the next part of that indicator by going to the MACD, and we'll change the signal line or the average line. I call it a signal line because that's what it's used for. It's really the average line. And I'm going to change this to a different color than what I see on top. I'm going to change it to red. We'll hit apply. And he smoothed this MACD line. So this red line is simply a 9-period moving average of the MACD line. So why would he do that? Well, for the same reason we smooth data up here, you could smooth this data. This is just a derivative of the data up here. Why not? So now you have a line that gives you some more, and this might be useful in identifying trends a little quicker than the MACD crossing zero. It's a little more aggressive, but it might be useful. So let's talk about this. I'm going to highlight using those ellipses that I used before. I'm going to do it here on this chart right here. We're just going to copy that a bunch of times, more times, because there are more crosses. Cross here, and here's a cross here. Now the direction of the cross is important. And what you might see, now there's a couple of crosses here, so it's kind of tangled up in love. We'll do something else up here. So the concept is the same. When we have a line that crosses a smoothed version of itself, that might be indicating trend change. So let's look at this. Here we got an indication back at the beginning of December of last year. And if we bring up our crosshairs, we can see exactly where that happened. That happened right here. So instead of waiting for this crossing signal, right, the truth was near the end of the trend. It was probably had a little bit more to go, but not much. I think I would have preferred to get a signal back here and a little bit higher, a little bit. Yes, we did have a little bit of a retracement, and you might have gotten stopped out if you're looking at a longer term trade. But still, if we were longer term holders, to go short here because my MACD gave me an indication I would have preferred than going short over here. So sometimes the signals are earlier in the trend when we use the crossing of the MACD and its average line, or what I call the signal line. Let's look over here. Here's a cross on the MACD and its signal line. Let's say we take the close as our entry point because we want to make sure that it does cross. Maybe it's this candle. Well, it's this candle, really. I think that's better than, if we were to go long on this candle, that would be better than going long on this candle, most likely. Cross below somewhere in this area. Maybe it wasn't here. Maybe it was here. But somewhere in this area, we might have gone short. Again, going short here is a better short if we're talking about the longer around here. So these signals, what Gerald Appel discovered was by taking an average of these, this MACD line, we could get earlier signals and maybe catch the trade a little bit better. I'll do this. Here's a cross above. We have the green line crossing above the red line. That's a bullish signal. Here's my bar that did that, most likely right here. So would I rather be long here or right up here? Well, I think I'd be rather be long here. So that's the thought behind smoothing that data. Again, it's like a doubly smoothed piece of data. The difference of these two moving averages, well, you're already smoothing the price data with these two moving averages. So MACD as an indication for trading can be interesting. Now, part of the study that kind of goes back to what he was trying to do up here with these moving averages. If I have two moving averages that I'm using for a crossing signal down into one set of data, take the difference. So I'm going to put on the histogram. Now, the interesting thing about the histogram is it's not a line, right? And the line might be confusing. Some people might prefer the line. They might like 3 lines. I like the histogram because I know exactly what it is. So let's go bring it back up. That's called the difference. But I call it the MACD histogram because I like it in a histogram. And we're going to use this gray value because it's just, I like it in a darker value. So what does the histogram do? Well, when the histogram crosses 0, that's when we see crosses in these two lines. Same concept. Just like the MACD crosses 0 is the difference, is when the difference of these two lines are 0 when they cross. Same thing with the MACD and its average line. The histogram, or the difference. Okay, so that's interesting. Well, there's one more thing we can use the histogram for, and this is where it gets a little bit aggressive. Sometimes I've seen traders use the change in the histogram as an indicator, but it's very aggressive. So when I look at my C in a downward trend, we'll try to isolate this a little better so we can see it on both the price and the chart. We'll focus on this downtrend. And I'll move this up a little bit. You see we have a trend here. We would have gotten short here, maybe gotten short here if we use the MACD crossing the 0 line, right? This green line is where these two lines cross. But at the same time, I've got this histogram is the difference of the MACD and its signal line. It's starting to turn up. So that momentum is starting to change. Now, it's not positive yet, but as what I would, in a perfect world, changing momentum and changing trends, you would see kind of a sine wave shape or pattern. And you see it generally not perfect, right? We see a little bit of an up move and then a retracement down. And then through up here, we see a little bit of retracement down, and not perfect sine wave, but it crosses, this histogram crosses above and below 0. So the thought is when that histogram stops increasing away from the 0 line, whichever direction, and starts trending towards the 0 line, is to take the trade in that direction. So if I were short here and then maybe this starts turning up, I might cover, or if I'm not in a position, I see that happening, maybe I go long. Now, you're not always going to get the longer trades that you want. Because look what happens. This does not follow through. That trend does not follow through, and it turns back around. So it's very aggressive, and you have to have you have to be very careful about trading that. Now, you can certainly apply this on an intraday chart. Doesn't really matter if this is a daily chart or a weekly chart or a 10-minute chart. And in fact, what I can do is I can go back to my intraday chart. Let's look at a 10-minute chart. And it looks very much the same. Start to trend down. These two lines are trending down as well. And then when we start to trend up, we see the market starts to trend up. We see these lines trend up. But here's the difference. These default values, 12, 26, and 9, were developed, I believe, for longer term trends or longer term charts. You might find, in fact, I think Gerald Appel uses shorter time periods. So he might use a 7, 21 for the two moving averages, and then a 6 for the moving average for the histogram, or for the signal line, I should say. So you can experiment with what works better for you with the MACD. Now, what else can happen? Let's go back to a daily chart. And I can just go over here to day and show one day. And here's trying to find some examples of divergence isn't always easy, but we'll try. And what do we see here? Well, I see some, I'm going to get rid of, actually, we'll do it the easy way. I can go remove all drawing objects, and I get the warning, and for sure, okay. So Gerald Appel himself will say this is a great divergence. And divergence is just when price and the indicator do not align in direction or intensity of direction. What do I mean by that? Well, let's look at peak highs and peak here. Peak high 1, we'll call this, let's see, if I hit F12, we'll call this peak high 1. Okay, and that's pointing right here at this peak here. I'm going to ignore this big wick here. And then we're going to just, let's see, copy that. I'm going to cancel. I'm going to copy, and then I'll paste it and drag it over. We'll call this peak high 2, though. Now, if I were to connect those two highs with a line, I'll use a ray. I'm just going to click on the top of that line and go to the top of this line. You can see it's increasing, right? These peaks are increasing. It doesn't really matter how fast it or far it extends. I could have used a regular line, but I can tell this is an uptrend, right? It's increasing. Now, what's happening on the MACD? Well, that peak high corresponds roughly with the peak high area in the MACD there. I'm going to use a ray right here. If I were to go here, kind of draw this line right where the MACD intersects, and then go to this peak high here, you'll see that it isn't increasing, it's decreasing. So when you see that this market can't get any higher, well, it is getting higher, but the MACD is not getting higher. The difference between the moving averages is not getting higher. That's a little bit of weakness. That means that the faster moving average isn't outperforming the slower moving average as much as it was the last time we had a peak high. We're higher than the last peak high. We should be increasing higher or faster, but it's not happening. In fact, the difference here of these two moving averages was greater than the difference here when we were higher. So what's happening? We're losing momentum. And so what happens is turnaround. So it can be, when we see divergence, it can be an indication of trend change. And when do we acknowledge it? Well, I would say when we fail to make a higher high. So we've still a peak high here. During this trend, we have a peak high. And as soon as we go past the previous peak high, But then we turn down, I'm concerned because I'm seeing this MACD not getting quite as high. And if we had been looking at this before or at this peak high, that to me is, wow, this is weak. Man, this is weak. This can't go much farther. And what do we have? We have a turnaround. So there's the divergence portion of that moving average convergence divergence. That is really, really powerful stuff if you can identify it. You won't always. Look what's happening now. We're getting new peak highs and the MACD is trending down. Is it worrisome? Could be. Could be an indication that this market might be losing steam. But I do have a cross above that signal line. So this is sometimes where the MACD can give conflicting signals. It isn't a perfect indicator. Nothing is. And we just have to be aware that sometimes we get indications just like they were in the past, and the market doesn't follow through the same way because there are so many things in the market that could be the reason. So to recap, we're running up against time. I just want to look back. We've kind of marked up this chart pretty good. I just want to go through some of the key concepts of the MACD. MACD is based on moving averages, in this case exponential, because they do reflect they place higher value on more recent data. It's the idea that smoothing data can help us identify trends and trend changes. Taking the difference of two moving averages is like identifying trend change. So distilling it down into an indicator where we can do the same by taking an average of that difference gives us some ways to interpret it, whether it's crossing a zero line, crossing a signal line, looking for divergence. These are all powerful ways that MACD can help us as traders. I've been using a daily chart, but again, you can use this on intraday to help you with your day trading. You can look at a 1 minute chart. You can look at a 5, 10-minute chart, 60-minute charts. You just might have to tweak the signals to get something that might fit your trading better. So I hope you enjoyed this. Next time we'll be we'll talk about another indicator, probably the most popular indicator after the moving average, called the relative strength index. I'm excited about that one. That'll be fun. A lot of similar concepts, but a lot of another way at the market and identify momentum. So that'll be in 2 weeks. And I do want to remind everybody, we finish off the week strong with Mike Burke today at 3:15. In the meantime, have a great trading day.